Welcome to this Killik Explains finance video. This week, with the end of the tax year approaching, how to compare an individual savings account with a self-invested personal pension. Now, there are other ways to save tax on your investments, but let's focus on what I call the big two. Now, the background basically is what? Essentially, tax-effective saving is a bit of a no-brainer. Why would you want your investments to attract tax if there's a way you can stop that happening? And both of these vehicles offer a way. There are quite a few ways to do it. So let's just look at these two for now. Individual savings accounts. I'm just going to look at the standard adult version and self-invested personal pensions as an increasingly common personal pension vehicle. Okay, so first of all, what have they got in common? Well, both are tax wrappers. Now people get confused here. So what does that mean? It means that basically you choose the investments that you want to put your money into over the long term. Now that could be anything from cash to a vast range of shares, to corporate bonds, to government bonds, to funds. All of those are eligible, and then you put one of these wrappers, or both of them if you like, separately over the top, and that provides a shelter for those investments. Now, both of these are available to UK investors, and the question therefore becomes, how do you weigh up which one you want to go for or in which order? A lot of people have both, but some will suit some people more than others. So ISAs versus SIPPs, let's take a look at the tax situation. Now, income tax is arguably the fiddliest in a way, so let's take a look at that first. So what is the position? So how much protection from income tax do you get? How does the income tax work? Well, with an ISA, basically there's no tax relief on payments in. Now, if you're wondering what that means, and this looks a bit almost like stating the obvious until you get to pensions in a moment, a pound paid in is a pound invested. All right. Now, the alternative is you might get more than the money paid in using a pension. We'll come back to that in a moment. There is then no income tax on interest, coupons or dividends received once that pound's invested inside the wrapper. Now, it could just be in cash, but cash isn't a great long-term home if you're trying to build wealth. But let's say you've got a mixture under the wrapper of things like shares paying dividends, bonds paying coupons, bit of cash paying interest. Well, the good news is inside the shelter, there is no income tax on any of that income. And funds can be withdrawn tax-free at any time. Now be careful, if you take money out of an ISA and you don't repay it within the same tax year, then you lose the benefit of that tax break I've just mentioned and a couple of others in the future. If you repay it back in within the same tax year, then it doesn't count towards your annual contribution limit for that year. So that's worth knowing. And people thinking, well, isn't there, a way you can get interest, for example, tax-free without an ISA, dividends tax-free through an allowance without an ISA? Yes, but those interest allowances and dividend allowances were introduced fairly recently, 2016. Already the dividend allowance has been reduced from 5,000 to 2,000. So who knows what could happen in the future. And for quite a few people who've got a broad range of investments, that won't be enough anyway to cover all of their dividend receipts, particularly not as those funds grow in value. So ISAs definitely still have a place. Now, with self-invested personal pensions, this is different. So there is tax relief on the way in. What that means is if you put 80p in, you get automatic basic rate relief, so another 20p added by the government, so that becomes a pound invested. As a higher rate taxpayer, 60p can become a pound invested thanks to the tax relief. You have to claim it a slightly different way through a tax return. It's not given at source, but it is there. And for an additional rate taxpayer, potentially 55p can become a pound invested. So that's quite a nice kicker up front, makes it different to an ISA. Then things get similar again. Once you've got your investments inside the wrapper, okay, then no income tax on interest, coupons or dividends. Same rules apply there. But you can't just pull money out. This is a long-term investment vehicle. There is a minimum age you need to get to, which is gradually creeping up, currently 55, and even then it's 25% of the fund that's tax-free with the rest taxed. Now hang on to that idea, because with an ISA we said you could withdraw everything tax-free potentially. Now, you might be thinking, well, the ability to take money out of an ISA makes it more attractive, but actually look at how the tax works here. So, quick comparison, lots of numbers, but I'm just going to focus on a few. Let's say we're comparing an ISA to a personal pension, a self-invested personal pension for a basic rate taxpayer, BRT, and a higher rate taxpayer, HRT. How does it look? Now I'm going to make some assumptions. So we're paying in £100 for the ISA, which means £100 is invested. As I mentioned, we're going to get some tax relief, basically, as taxpayers at the basic rate and the higher rate. We get different amounts of tax relief, but nonetheless we're investing the same amount overall. And remember, the method for getting the full tax relief as a higher rate taxpayer isn't quite the same as it is for the basic rate relief, but we'll leave that to one side for a moment. Let's assume we've got £100 invested in each case. Now, let's assume we've done well. Now, this is an assumption. Things can go down as well as up, all the usual risk warnings apply, but let's say we double our money in every case, whichever vehicle we've picked. So there's £200 in there, and now we're thinking, what could we pull out? Now, with a personal pension, you'd need to be at the minimum retirement age to do anything. Let's assume we've got there. Basically, with an ISA, you can just pull the whole lot out tax-free, hence the zeros. The net benefit column on the right is just saying you've made £100. You put £100 in, it doubled, you've made 100% on your original investment. Compare that to a pension, because that sounds good. Compare that to a pension. As a basic rate taxpayer, £100 in became £200. That's because the investments did well and they're protected from tax as they go along. Now, you can pull out the first 25% tax-free, leaving £150 to be taxed. I've taken tax off, made an assumption, ignored the income tax-free allowance here, but said, let's say that's £30 worth of tax at 20%. So the net benefit is what? Well, you paid in £80 to take out 50 plus another 150 minus £30 of tax. Add that all along, the net benefit overall is £90. 90 over 80, back here, is 112.5%. The numbers are less important than the point. You are getting a bit extra from the long-term investment vehicle, the SIPP. Now, for a higher rate taxpayer, and this is why the media look at this and wonder whether the HMRC are going to do something about this, maybe reduce the relief. Look at this. So for a higher rate taxpayer, £60 went in, £100 was invested, grew to 200. That's an assumption, by the way. We take out the first 50, that's 25% tax-free. That leaves 150. We're going to be walloped, let's assume, for higher rate tax, ignoring personal allowances and so on, at £60. Well, that basically means the net benefit is 80. How do I get to that? Comparing 60 to the 50 out and 150 minus 60 or 90 on that side gives you 80 or 133%, because 80 over 60, 133. So this is why sometimes people worry that this higher rate relief might be taken away at some point, because basically you've got 133% benefit, if you want to see it that way, from your original investment. But then you've had to wait to get your money out. And if, by the way, if you can pull this trick off, food for thought, if you pay in as a higher rate taxpayer but pull money out as a basic rate taxpayer, then that return rises to more like 150%. So there we are, food for thought. Now, capital gains tax and inheritance tax. This will be a lot quicker. Capital gains tax, the story, you may be relieved to know, with ISAs and SIPPs is broadly similar, insofar as investments can grow in value tax-free inside the wrapper in both cases, and there's no CGT payable on withdrawal. So no matter how big the gain, when you finally cash in, let's say, there'll be no capital gains tax to pay. So that keeps things relatively simple. Inheritance tax, watch out. Things are not quite as straightforward. There is a twist here. So ISAs are part of a death estate and may be subject to inheritance tax of 40%. Now, there are a couple of quirks to be aware of. One is that if, it's a big if, you're investing in certain qualifying shares, AIM shares for example, within the ISA, you may be able to get around this inheritance tax problem, but most people will hit that inheritance tax problem, which is why sometimes retirees choose to spend their ISAs first. All right. The other things just mentioned about ISAs is that there is an ability for one spouse to transfer to another on death. There's a thing called an additional permitted subscription. Not everyone takes advantage of it, to preserve the ISA benefits. Doesn't necessarily help you with inheritance tax, but it does preserve the income tax and capital gains tax problem. More about that in other videos. Pensions, on the other hand, are not considered part of a death estate, and therefore you don't have the problem to deal with in the first place. So food for thought. Further thoughts, comparing the two together, the limits are different. So the amount you can pay into an ISA is £20,000 per person per tax year. It's actually quite a bit higher, subject to a net relevant earnings check for a pension. All right, and you need to watch out. If you're floating at a certain level, that contribution may be tapered down to much less, as little as £10,000 potentially, but you can carry forward unused allowances. Not true of ISAs. ISAs are use it or lose it, so don't confuse those 2 points. On top of that, pensions can attract employers' contributions. ISAs very, very rarely do, but your employer might pay into a personal pension for you, and that's worth bearing in mind because the compounding effect, even a small contribution, is sizable. and the rules can change at any time. The minimum retirement age is one to keep an eye on with personal pensions. But then most of us, I think, are not looking down the barrel of a conventional retirement these days anyway. Editor@killik.com with questions. And if you want to watch videos that take some of these topics into a bit more detail, killik.com/learn, and it's the tax effective savings tab.